Welcome to StockMarketFunding.com, home to the professional traders that come to our school, home to new people who want to be traders, who are going to be successful at what they do in our school. Now, what we have here today, people, is that this is a call or a put option up here called a $500 put option on Google. And I'm going to show you where Google closed. Is that Google had a closing price of $566. And this is a $500 put, and we're going to report earnings on 4/15. Google's going to make a big move one way or the other. So basically, this is where the stock is. This is the cost of this $500 put up here. Which is $66 below the marketplace, as you can see. That's number one. Number two is that the put option, this $500 put option, was as high as $8 on 325, and now it's $6 cheaper. So when we buy that downside protection in our risk management trade, that means we have taken $6 of risk out. So if I'm buying 10 contracts, I just saved $6,000 in my downside risk. I'm protecting my trade. That's the $500 put. Now, on the other side, this is a $630 call. Now, let it be known that they're both May contract options on Google. And the $630 call, as you know, Google closing at $566. So it's a $630 call, way up and out of the money. The 52-week high on Google was $629.50, by the way. And basically, when I show you over here that the call option was $6, and we're going to be buying these for between $2.50 and $3. 10 contracts for $3,000. So if Google pops $30 or $40 on its earnings report, that means that these contracts are going to get above $20 a contract. So if I make $20,000 here and I lose $2,000 here, well, I still make $18,000. And the thing about it is, on high beta stocks during earnings season, Google's going to make a big pop one way or the other. And we did this last quarter where the earnings were really great on Google, but it fell from 629 down to 520. And that meant that that put option made a lot of money and you lost money on the calls. Okay. What it really comes down to is that both sides of the trade are wholesale entries. You're not buying the $630 May call up here at $6 for $6,000 for 10 contracts, but rather what you are doing is you're buying the $630 call, which is right here. It's 290 by 310, and you're saving $3,000 on your entry here, and you're saving $6,000 on that put option. So if Google came out, missed its earnings, and guided the quarter down, well, guess what, people? You'd lose money here, but this side of the market would go way up. And if I lost $3,000 here and made $15,000 here, I still make $12,000. And I'm on both sides of that earnings report. And that's called risk management. That's phase 1 of risk management. Phase 2 of risk management is to understand it's a rare opportunity to get both sides of that greater movement at this very wholesale price. This is retail prices up here, people. These are retail prices up here. Buying down here to protect your money is wholesale, and even buying down here compared to the retail side, you're still buying wholesale, and that's trading the Google earnings.